Good morning, traders. Welcome to Expert Trader UK's daily market pulse for October 22nd, 2025. Global financial markets are highly volatile today, driven by conflicting U.S. macro signals and ongoing geopolitical uncertainty in Asia and the Middle East. The most significant domestic development is a sharp contraction in U.S. industrial activity, revealed by the Philadelphia Fed Manufacturing Index. This dovish shock reinforces the narrative for continued accommodative monetary policy by the Federal Reserve, contrasting with a violent unwinding of precious metals. Risk sentiment remains suppressed by heightened U.S. China trade uncertainty, contributing to broad declines across Asian equities overnight. Today's session requires strategic positioning to absorb the Philly Fed miss, monitor commodity stabilization, and anticipate reactions to high-stakes technology earnings from Tesla and Intel. The headline shock of the day is the Philadelphia Fed Manufacturing Index for October 2025, which saw manufacturing activity contract sharply. The diffusion index plummeted 36 points to minus 12.8 in October, a 6-month low and a severe reversal from September's plus 23.2. This unexpected slowdown, far exceeding the market consensus of plus 10, suggests industrial deceleration is occurring faster than predicted. This data, collected in the first 2 weeks of October, provides concrete evidence of rapidly weakening industrial trends, particularly concerning shipments and new orders. Shipments fell 20 points, though remaining positive at 6.0, while new orders rose 6 points to 18.2, indicating a sharp slowdown in manufacturing. The immediate implication is a reinforced expectation of highly accommodative Federal Reserve policy, validating September's rate cut and increasing the probability of further monetary easing. Investors must weigh the bullish dovish Fed put against the bearish warning of an impending economic recession. Fixed income markets should anticipate further yield compression, while cyclical sectors like industrials may face ongoing selling pressure. Following the stark manufacturing data, attention now shifts to the U.S. labor market, with the JOLTS data for August 2025 due at 10 a.m. Eastern Time. Analysts are closely monitoring this report for confirmation of weakening labor market conditions. A significant shortfall in job openings would compound economic pessimism. Tomorrow, October 23rd, 2025, brings NAR existing home sales data at 10 a.m. Eastern Time, a critical gauge of housing market health. Additionally, the Bank of Canada interest rate decision will signal potential policy divergence, impacting the Canadian dollar and overall market sentiment. The most dramatic price action today is the catastrophic plunge in the precious metals complex, with gold suffering a colossal 5.7% drop on October 22nd. This sell-off ranks as the fifth worst daily trading session on record dating back to 1970, following an extraordinary months-long rally. This sharp reversal confirms gold had devolved into a pure momentum trade, denying meaningful pullback and forcing prices deep into overbought technical territories. The sudden snap is attributed to technical liquidation, heavy long-side profit-taking, and a rebound in the US dollar, underlined by high trading volume. Traders are now closely watching the critical $4,000 support level for signs of market stabilization. The swift translation of this volatility into the equity market was immediate for gold-related stocks, with Newmont Corporation losing 9.0% yesterday. In contrast to precious metals, the energy complex demonstrated relative stability, with crude oil rising 1.80% to $58.27 per barrel. This moderate strength supports the energy sector, exemplified by Halliburton's substantial 11.6% surge yesterday. This decoupling from the gold market suggests investors assess geopolitical risks as contained, despite ongoing conflicts. In currency markets, the US dollar's recent strength highlights its role as a preferred global liquidity and risk-off refuge. Attention is focused on the British pound as traders anticipate upcoming inflation data to clarify the UK monetary policy path. Structural volatility from global trade policy and geopolitical uncertainty remains a major headwind for global growth projections. The WTO warns that a full US-China decoupling could reduce global economic output by 7% over the long term, underscoring the cost of protectionism. S&P Global Ratings consistently points out that U.S. policy unpredictability, particularly concerning tariffs, acts as a structural drag on global investment. Policy uncertainty discourages investment and consumer spending, meaning output and employment are lower than they otherwise would be. Asian equity markets widely slipped on October 22nd, reflecting regional profit-taking and heightened caution from U.S.-China trade rhetoric. China's Shanghai Composite fell 0.44% to 3,899 points. Hong Kong's HSI trimmed 1.32%, and Japan's Nikkei shed 0.55%. Remarks by former U.S. President Donald Trump regarding a planned trade meeting with Chinese President Xi Jinping injected renewed anxiety into the market. In the Middle East, diplomatic efforts continue, with the UAE emphasizing security for Israel and a viable Palestinian state. The IMF projects global growth will slow to 3.2% in 2025, noting downside risks remain tilted toward prolonged uncertainty and protectionism. This environment places a premium on corporate financial resilience, with a market preference for dominant technology companies. The Bloomberg Magnificent 7 Index had aggregated free cash flow of $307 per share in the first half of 2025, compared to just $43 per share for the Bloomberg 500X Magnificent 7. This colossal FCF gap provides survival capital, allowing these tech giants to fund R&D, absorb supply chain volatility, and execute shareholder-friendly capital deployment. This financial strength provides a robust buffer against macroeconomic turbulence and geopolitical instability, justifying their dominant market share. The current earnings season continues to dictate sectoral performance and market volatility, with significant reports delivered last night and due after the market closes today. Netflix Inc. experienced a sharp drop in after-hours trading on October 21st, reporting EPS of $5.87, significantly missing the $6.96 consensus estimate. The company attributed the profit shortfall to an unexpected $619 million expense from a tax dispute in Brazil, causing shares to fall 5% to 6%. This heightened margin sensitivity establishes a tense environment for today's high-stakes technology reporters. A critical roster of defensive, industrial, and consumer staples names report today before market open, including General Motors, Coca-Cola, and Verizon. Traders will keenly observe if General Motors' actual results can justify the massive 14.9% surge the stock experienced yesterday. The true market volatility driver, however, is scheduled for after the market close: Tesla and Intel Corporation. For Tesla, investor scrutiny will center intensely on Q4 guidance, especially with the expiration of U.S. electric vehicle tax credits. Intel's report is pivotal, providing insight into the global semiconductor supply chain and capital expenditure plans for corporate computing infrastructure. The previous session saw highly concentrated movement, particularly in response to the gold price collapse and continued momentum in select industrial and energy names. Top gainers included GM and Halliburton, while top losers were Newmont Corporation and Albemarle. The extreme loss by Newmont directly confirmed the punitive translation of gold price liquidation into equity valuations. Conversely, Halliburton's substantial gain suggests strengthening conviction in the energy services sector, supported by crude oil price stabilization. The aggressive positioning in General Motors confirms market expectations for a positive earnings and guidance report today. The confluence of industrial contraction, historic commodity liquidation, and persistent geopolitical uncertainty underscores the necessity of a nuanced investment strategy. Analysts maintain a cautiously bullish stance, but strongly advocate for portfolio diversification, as market concentration in technology has led to stretched valuations. While the financial superiority of tech giants provides a buffer, investors are urged to broaden participation into cyclical sectors like industrials and utilities. Asset allocation must prioritize fundamental resilience and strategic exposure to less volatile, more domestically focused sectors. Key releases requiring immediate attention include today's state job openings and labor turnover, and after-close earnings from Tesla and Intel. Tomorrow, October 23rd, 2025, brings existing home sales data and the Bank of Canada interest rate decision. Remember, trading stocks, shares, commodities, and derivatives involves substantial risk of loss and is not suitable for all investors. Before trading, carefully consider your investment objectives, experience, and risk appetite. Seek independent advice if you have any doubts. This research was conducted by Expert Trader UK. If this report helps inform your trading strategy, please like this video and subscribe for your daily dose of market intelligence.